Nancy, where are you adding to positions at this point? Are you sitting tight?
No, we're adding. I mean, we've been taking some gains in some of the names that, have had a nice run since last summer. And we've been adding around the edges to names like Corning, for example. We added recently to some of the consumer discretionary names I mentioned earlier. So we are remaining, we're keeping our portfolios bifurcated with the hedge I mentioned in place. And we're trying to be careful not to take to take enough risk and not to pull back on the risk spectrum, because we do think we're in the early phases of a new or continued bull market, and we want to be exposed. We don't want to just go after the deep value play because we think that's a cyclical trade.
That's interesting. Greg, Mike has been asking all day whether the market is in a sweet spot now, or is this as good as it gets? It sounds to me like Nancy thinks we're in more of a sweet spot. What about you?
So long term, I agree. I think that there is a powerful back half story of earnings and consensus being too light. The jobs number, I think, is indicative of that. It came in 50% higher than consensus. And so we haven't reached on estimates yet the pre-pandemic levels. Many sectors' estimates are good 30, 40% below those levels. But there is something we have to watch out for, which is a spike in inflation, although we know it is coming. If it is more acute than the Fed said, the 2.2%, that level at which they would not worry about it, it may very well force the Fed's hand, and I think the market's keeping one eye on that.
So how do you position for that scenario, Greg?
So right now we're taking a wait-and-see approach. Like I said, there are certain companies in certain sectors that we feel have a very powerful back half story. But when we see that spike, the market's going to react the way it reacts. And so a spike in inflation would drive yields. And when we drive yields, that is more deleterious for tech and growth than it is for value and cyclicals. So on the tech growth side, we're sticking with stories that we know have legs, that we know have a powerful growth story that is underappreciated.
Mike, rates are very much going to drive the answer to your question, right?
Probably so. Obviously, it's a big part of the mix. The market has been sort of left to search for its own pain point on rates. The Fed's not going to step in there and do much of anything to block it at this stage. And I think it can make its peace at successively higher yield levels. It's shown it can do that. It's just sort of a matter of which stocks can perform and lag in that type of environment. We've been above 1.7. During this run, we've been actually almost to 1.8. So each time it kind of has to prove that it can sustain itself in terms of valuations at those levels. Yeah.
Shepard Smith here. Thanks for watching CNBC on YouTube.